Did you hear that there is an infinite money glitch going on in the stock market right now? I only just found out about this, and we are going to be watching exactly how it's done today, live. You're watching this live with me right now. The infinite money glitch. Let's go.
In India, every time $1 worth of stock is bought and sold, there's over $400 worth of derivatives contracts being traded. That is not normal. India has quickly become the epicenter for speculating on short-term stock price movements, and while the many amateur traders are losing about half a year's salary from placing these bets, there's a huge Wall Street firm that's found a way to make billions there.
You have been all over the Jane Street story.
Jane Street.
Jane Street.
Jane Street.
Jane Street. Jane Street.
Jane Street.
Jane Street Capital found what was effectively an infinite money glitch that's been so lucrative they surpassed Morgan Stanley and Bank of America in trading revenues last year. In fact, their strategy was too good because India just banned them completely.
SEBI has barred US trading firm Jane Street.
Okay, so I'm editing right now and this report just came out that they're not banned anymore. Doesn't change the rest of the video, but yeah, I thought I'd better chuck that in.
What it calls unlawful gains from the US trading firm.
Let me unravel the mystery behind Jane Street's trading strategy, how they leaked their secrets in a pointless lawsuit, and why regulators deemed the whole scheme to be nothing more than good old-fashioned market manipulation.
Well, this is interesting. Now, you may have heard of a term called arbitrage, right? Where you can buy one asset for a lower price and then sell it for a higher price. In fact, I remember listening to the Market Wizards not all that long ago on Audible, and one of them would do that with gold. He would buy it in the Asian markets, Hong Kong, China, wherever he was getting it from, at one price, and then the US markets, he would then sell it back at a higher price, right? That was the arbitrage. Buy low, sell high with no issue in liquidity because everybody who could transact is transacting. And all he was doing was buying at one price, selling at another. In fact, in the early days of crypto, that was a big deal, right? You could buy it on one exchange for one price and sell it on another exchange for another price, and then you keep the spread. I'm curious if it's something like that.
The strategy that's printed billions in profits was born out of the insane trading mania that's taken hold of India's financial markets. Options trading has exploded. About $4 trillion worth of equity derivatives are traded every day on India's national stock exchange, meaning India's relatively small stock market is responsible for roughly 80% of the world's options bets. This report from FIA really helps to 80 stock exchange, meaning India's relatively small stock has exploded. About $4 trillion worth of equity derivatives are traded every day on India's national stock exchange, meaning India's relatively small stock market is responsible for roughly 80% of the world's options bet.
Something doesn't smell right. That's interesting. Something really doesn't smell right on that.
This report from FIA really helps to drive home how violent this boom is. In 2022, globally there were 54.6 billion options contracts that swapped hands. In 2023, that number doubled, 53 billion more contracts than the previous year. And of that...
What? Okay, I have not watched this video, so it's probably going to be obvious in a minute. But this is crazy talk. It doubled in a single year?
51 billion came from India alone. Options contracts and other derivatives are a way to bet on how a stock's price will move in the short term, without actually having to own the stock. In the US, their huge derivatives market is 9 times bigger than the actual market for trading shares. In India, it's 400...
Whoa! Whoa! Okay. Context. Options, like the one option contract is worth 100 shares, okay? So it's saying that basically the notional leverage, if I'm understanding this correctly, the notional leverage is 9x what the number of shares is, right? So the leverage essentially, if you took all the option contracts to all the shares, 9 to 1. At least that's how I'm understanding it. In India, it's 422 to 1. This is crazy.
122 times larger.
How much bigger is the market for insuring mortgage bonds than actual mortgages?
About 20 times.
Jokes aside, India's ballooning derivatives market is a completely different...
Hold on. Did anybody hear that? Okay, funny story. Funny side tangent. My family and I went to Scotland last year, and we kept making these jokes that when we got to Scotland, out in the back, off in the distance, you could hear something. You could hear bagpipes off in the distance, all over the place, right? I'm sure people feel that way when they get to Texas, that they'll hear country music everywhere they go, right? Same concept. So we were walking around Edinburgh and doing our thing, and I look over at my son and I'm like, do you hear that off in the distance? And it was a bagpiper off in the distance, and it was just such a fun moment. But did you hear in the background of this? Tell me in the background what you hear. Hang on.
India, it's 422 times larger.
How much bigger is the market for insuring mortgage bonds than actual mortgages?
About 20 times.
Did y'all hear Slash in the background? Whoa, sweet child of mine. Dude, I love Slash. I got to see Slash in concert in 2004. One of the coolest memories ever. Anyway, total side tangent. We're back to this.
Jokes aside, India's ballooning derivatives market is a completely different situation than the mortgage crisis in 2008, but that doesn't mean it comes without problems. India's securities regulator, SEBI, did a study that found 9 out of 10 individual traders in equity futures and options lost money in 2022, and they're not losing pocket change. The average losing trader lost about 110,000 rupees that year, which for context is about half the annual salary of a typical Indian worker. Imagine making $60,000 in America and losing 30,000 of it trading options. That's the average experience of a derivatives trader in India. Part of the explosion in market speculation is credited to the country's stock market boom, which has been on an 8-year bull run. Confidence and greed have surged, and those looking for even bigger returns are turning to the high risk, high reward of options trading. For the government, exchanges, and brokers, this has meant raking in more fees and commissions, all while traders, including a flood of men in their 20s and 30s, are almost all losing. The derivatives market is a
Interesting, right? Now the stat, I mentioned it this morning. For those of you who didn't watch it, right? The stat is 90% of traders lose 90% of their accounts in the first 90 days of trading. It feels like that's what's happening in India. All of these young gentlemen, and I don't know where they're getting their money from, are taking their money and blowing it in the stock market because they're treating it like gambling. In fact, that's exactly what we talked about in this morning's live stream. But man, if you can break even year one, you are in the top 10% of traders, because remember, 90% of traders lose 90% in the first 90 days, right? So if you've broken even year one, you are in the upper echelon of all traders. I know it sounds crazy, but it's true, right? Year two, if you can repeat the success of year one, you are on your way to being one of the greatest traders that's ever lived. I know it sounds crazy, but it's true. I wasn't able to do that. Blew my account twice, right? I lost 2/3 of my account in 60 days. That's what Chris did. So maybe that's what's going on. I don't know.
Zero-sum game. If someone is losing money, then someone is making money on the winning side of the trade. So if 90% of individual investors are losing, it begs the question,
90% losing.
which traders are taking it all?
This is a firm that has been in the background. They're making billions of dollars, but now the way that they're doing that has been thrust into the open. So
Jane Street Capital is a Wall Street firm that until recently was flying well under the radar. In fact, I wouldn't even be surprised if you hadn't heard of them. Founded in 1999, Jane Street is relatively young by financial institution standards. They're a proprietary trading firm, meaning they trade stocks, bonds, options, and other securities with their own money. So unlike a hedge fund, which is investing money on behalf of clients, Jane Street uses its $30 billion of members' equity and some debt to play.
Okay, there you go. Which means everybody watching this, if you trade your own account, you are a prop firm. You're trading with your own money. Congratulations. You are a fund manager at your own prop firm. Congratulations. Add that to your LinkedIn resume. Go for it.
trades. The benefit being that they're not constrained by some of the banking regulations that exist to protect clients. They can be more aggressive and very secretive about the strategies that they're using to profit. And boy, have they hit it big recently. Their 2024 financial results were jaw-dropping. Net trading revenue doubled to about $20.5 billion. This year, in the first quarter, they were expected to do $7.2 billion, which puts them in the same league as some of Wall Street's biggest firms. They surpassed Morgan Stanley and sit only marginally behind Goldman Sachs and JP Morgan's trading divisions. Even more impressive, they have a profit margin of about 64%, with an estimated profit of $4.6 billion for Q1. How on earth are they making so much money? Jane Street is known as a market maker, essentially a liquidity provider. They are actively buying and selling securities to ensure there's always a price and counterparty available in the market. When someone buys a stock, they take the other side of the trade and earn a tiny profit on the transaction. Last year, Jane Street was behind more than 10% of all trading volume in the US, including $700 billion worth of ETFs every single month. They of course also use a variety of strategies to profit from short-term price movements, but no one really knows how they're so successful. They've been labeled the secretive US firm that no one's heard of, and they almost never talk to the media. Fun fact, you might have actually heard about Jane Street a few years ago when crypto fraud Sam Bankman-Fried was jailed for siphoning customer deposits out of FTX. Sam's first Wall Street job was as a trader at Jane Street, only leaving the firm in 2017 to start the now defunct crypto exchange. But some of the mystery behind Jane Street's success is now known to be associated with their business in India. They entered the Indian markets in 2020, and in 2023, after years of researching and testing, their new strategy came to full maturity, and their revenues went parabolic. Yes, they've been growing globally too, but their business in India has become very meaningful. The burning question being, what did they find in India that was so damn profitable? Just a quick reminder to hit the subscribe button if you're enjoying.
Absolutely, go subscribe to this channel. I am subscribed, as you can see right here. That's how I saw this video.
In the video, and you want to see more of my videos appear on your homepage every now and then. Thanks to the investigation from India's regulators and the 100-page analysis they provided, we now know exactly what they found. It's actually pretty clever and a bit devious. Intraday index manipulation. That's a mouthful, but here's how it worked with a real example from the 17th of January 2024. On that day, the Nifty Bank Index opened down around 3%. This index is a basket of India's biggest banking stocks. One of India's biggest banks, HDFC, had reported disappointing financial results that was dragging the whole index down after the opening bell. So Jane Street steps in and starts aggressively buying shares in some of the bank Nifty stocks. We can actually see all of the trades here in the report. At 9:15, when the market opened, they bought HDFC, ICICI, SPIN, and a few other banking stocks. For most of these, they were accounting for 20 to 25% of all the buying. And
imagine Citibank, Wells Fargo, Bank of America, and your firm just did 25% of, well, not your firm, but you just did 25% of all trading volume. That is not insignificant. That's huge numbers.
And this was all done within the first couple hours of trading. In total, they acquired roughly $500 million worth of these companies. And their buying was so aggressive that they essentially managed to prop up the price of the index by.
So this is, I forget who said it, but not long ago, we were having this conversation in OVTLYR University. Hang on, that's a good segue. Hang on.
Are you ready? Let's go!
Respect is earned. Respect is never given.
Exactly. This is the conversation we have, which is what happens with the outlier effect. Now, we've seen the outlier effect in action, and we are just itty bitty baby fish, right? When enough people start buying something that can influence the price. Think of GameStop, think of AMC, right? When enough people collectively buy, that's going to push the price up. Okay. There is one of the market wizards, I don't remember who talked about how, I think it was Paul Tudor Jones. He said that he became the market. He was so big, whatever he bought moved because he bought it. And he was so big that whatever he sold went down because he bought it. That's awesome, right? And now we had this conversation in the OVTLYR University. And I was like, listen, if you reach a point where you are so big, right? You're trading 8 figures, 9 figures. And every time you buy, a news article comes out. Whale just buys 30,000 Bank of America calls. You know, unusual whale starts doing reports on you. You move the market. At that point, you don't have to trade any bigger. You could probably trade a lot smaller because your movements will impact the results of the overall trade, right? So for example, let's say that you buy. As it starts to get filled, right? The bigger in size you get, the more you're going to see this. As it starts to get filled, it's not going to get filled in one order. It's going to take a few orders. It might take 20 orders to fill all this. It might take 100 orders to fill all this. So as it's getting filled, what's happening to the price? Price of the stock is going up. Okay. So you're getting a worse and worse price when you just wanted to enter. And then when you sell, guess what happens, right? You start selling and all of these orders are coming through and the price of the stock is going down and down and down because you are creating the volume of the market. Right? That's what we're calling the outlier effect. Now, it sounds like that's exactly what happened here. The market opened way down, so they bought the mess out of these stocks. And because of that, it's starting pushing everything up. Now, real quick, that segue to OVTLYR University. We go live every Tuesday and Thursday in the afternoon with a group of gentlemen in class who, a lot of them, maybe more than 50% at this point, are so profitable. We're talking 20, 30, 40% gains on the year so far, and they have not even completed all of OVTLYR U, right? So here's the deal. OVTLYR U has a 100% money back guarantee. If you don't love it, you can have all your money back in OVTLYR University because it's free here on YouTube. We don't charge anything. We don't make you go to a masterclass. It's all free here on YouTube. Now, 50% of you are going to listen. It's going to go in one ear and out the other, and you're not going to do anything about it. 25% of you are going to listen half-heartedly, go implement a trade. It's not going to work out. You're going to come back and say that Chris is such a scam artist. He doesn't know what he's talking about. What a fake guru. But 25% of you are going to listen. You're going to implement it correctly, and you're going to create generational wealth. You get to choose what the outcome will be. So, with that out of the way, let's get back to the video.
By brute force. They were acting like the world's most generous buyer, holding up the market when everyone else wanted to sell. Now, why on earth would they want to do that? Well, options prices, specifically the price of put option contracts on the Bank Nifty index. A put option is essentially a bet that a stock or index will go down over a certain period. You can even buy put options to bet on the index falling later that same day. And the price to place such a bet is influenced by the price movements of the actual index. If the Bank Nifty was falling at the open, the price to bet on it declining further normally goes up, because a continuing decline throughout the day now seems more likely. But Jane Street's massive stock purchases caused the index to rise in the morning, or at least to stabilize it, which in turn made buying put options cheaper than they otherwise would have been. Again, SEBI's report lays all of this out. This is one of the put option contracts from that morning. It has a strike price of 46,800, which was a little above the price where the index started that day. It had an expiry on that same day, and the price was 229. So this is effectively a bet that the index will continue to fall throughout the day, and it costs 229 rupee. But within just a few minutes, the cost of that option bet goes down a lot. 123, 104, 82. and eventually to just 65 by 920. It's getting cheaper because with all of Jane Street's aggressive buying, suddenly a market decline doesn't look as likely. And they took full advantage of this, buying a ton of these put option bets. Their bet that the index...
Oh, shoot. Do you see what's about to happen? I see it. I see it. Here's what they did. They bought the mess out of it when the market opened down. They were the market that pushed the price up. Because the price went up, they decided to start buying all the puts that were super cheap, and they're about to drop all of those stocks, which is going to push the market down. Oh yeah, they just rug pulled it. Oh yeah.
Index would decline in the afternoon was more than 7 times larger than the money that actually spent on banking stocks. Which brings us to phase 2. After spending the morning supporting those...
This is genius. All right. When the market opens, here's the meeting. I'm telling you, here's what the meeting is. Here's the deal. All right, we got so much money. Okay, when the market opens down, we're going to buy up all the stocks that we can. Okay, we'll buy the actual equity. It's going to push it up, and then the put options are going to get really, really, really cheap. Okay, so then while the price is pushed up, we're going to buy the mess out of these put options. Then once we've got enough put options, we can sell those shares and it'll plummet the price of the stock. And then we get to make 10 times as much money on the put options. I guarantee you that is exactly what happened. Yes. Throw it out, OVTLYR 9. We need to start doing this.
bank stocks and quietly stockpiling cheap put options, Jane Street flips the script, suddenly dumping all of the banking stocks they had bought, essentially pulling the rug out from under the market.
Wow, look at that. A pump and dump, double rug pull. Yeah. Wow, this is awesome. Only from a trader would you say, wow, this is awesome. How brilliant.
The stock prices of those banks resume their decline, and in turn, the Bank Nifty index also falls. Jane Street lost money on this aggressive trading. They were buying high in the morning and selling lower in the afternoon. But that was all part of the plan, because guess what happened to the put options that they were holding?
They may have lost money on the stock when they pushed it up, but those put options probably paid 10 times more.
As the index fell in price, they skyrocketed in value. That bet we were looking at before that got as cheap as 65 rupees at 920, when the market closed that day, they were
a 10x return, greater than a 10 times return. Wow. I wish I had enough money to throw that around. That's awesome. This is leverage in action. Yeah. 10x on the puts. Exactly. Wow.
Worth over 700. The same was true for all of the other ones. Started the day at 500, was pushed down to 180, and then finished the day worth more than 1,000. The profits from the put option bets massively outweighed the losses that they experienced from dumping their stock position. SEBI estimates that Jane Street made about 85 million US dollars that day from using this trading strategy. A strategy that's only possible because India's options market is so much bigger than the actual stock market. When they'd buy and sell stocks aggressively, it would manipulate the prices. But since there was so much liquidity in the options market, they could acquire a huge bet without affecting the contract prices. Just a quick side story, this chart showing how insane India's options market was posted on Reddit back in 2023, and one guy actually predicted that a firm might use this exact strategy to profit. If you can move the leverage needle in a 422 times market by moving money around in a 1 times unleveraged market, then in a corrupt country like ours, you bet fraudsters are going to manipulate the cash delivery market to find 10x or more money in the derivatives market. I won't go into too much more detail, but Jane Street...
This is so brilliant, right? Prop up the market with shares. When the market's super high, buy the mess out of the puts that are not going to impact the overall market because there's so much liquidity. The puts are ultra cheap. Sell your shares even at a loss, but the puts explode in value. Wow, this is sick. I love it.
also used other strategies like extended marking the close, where they'd trade heavily right before the markets closed to influence the closing price of a stock. But all in all, it was ridiculously profitable, to the tune of 4.3 billion US dollars in profit between January 2023 and March 2025. An actual infinite money glitch.
Yeah, legit. That sounds like market manipulation. Yeah, that's what they were charging them with. But should it be illegal? I don't know how it could be illegal, right? I mean, legitimately, this is smart trading. I don't know how this could be illegal. In fact, tell me how this could be illegal. Because if I knew that I could move the market by having a big enough trade size up or down, which is exactly what they did. They moved it up and then they moved it back down. And these puts are out there available for sale. You know, they got the guy out on the corner. He's like, hey, selling puts here, 2 puts for $1. Come and get some. Come get your puts right here. Put a little mustard on the side. Puts are for sale all day, every day. And you're like, I'll take some puts. I don't know. It feels like crazy trading and awesome. I love it. I would love to be the guy doing this.
Until it suddenly wasn't. There's a fair bit of debate at the moment around whether what Jane Street did actually constitutes market manipulation, but India's regulators certainly thought so. Quote, dealing in multiple segments across cash equity, stock futures, and index options simultaneously is certainly not by itself a breach of any regulation.
Exactly. But what's wrong with doing this? This is smart trading to me. If you are a big enough whale to swing your banana around, and it does all kinds of stuff like this. Just saying. I mean, I see how it totally works.
Regulation. The problem in the eyes of regulators was the intensity, scale, and intent behind the trades. The intensity and sheer scale of their intervention in the underlying stock and futures markets, the rapid reversal of these large and aggressive trades in cash and futures without any plausible economic rationale. In plain English, it's of course okay to trade stocks and trade options at the same time, but each of those trades individually on their own needs to make sense. Jane Street's trades in the stocks didn't make any independent sense. Buying a huge amount of shares in the morning and then dumping them a few hours later for a big loss is not a normal profit-seeking strategy unless you're doing it to manipulate something else. SEBI's final estimate of the profits generated illegally was about 570 million US dollars, all of which Jane Street was ordered to forfeit. And there's always an irony to these stories. The way that regulators even caught wind of this trade is a hilarious self-inflicted wound. A pointless lawsuit that Jane Street initiated itself. In April 2024, they filed a claim against 2 of their former traders, alleging that they had taken this brilliant India strategy to a rival firm, Millennium Management. In the heavily redacted court filing, they claimed that the trading strategy had generated $1 billion in profit in 2023 alone. Bloomberg published a story about the lawsuit titled "Ex-Jane Street Trader Pillories Claim He Stole Trade Secrets." And that exact article is cited in the SEBI report as the catalyst of the investigation. So they basically leaked their own strategy over a pointless lawsuit. Also, if anyone has information about the potential consequences of India's enormous derivatives market, feel free to leave a comment or send me an email. I feel like there's a deeper story there, another rabbit hole for me to go down. Subscribe if you enjoyed, and consider checking out this playlist.
Dude, so sick. So freaking sick. I want to do this one day when I grow up. When my account grows up to big enough where I can be the whale swinging bananas around. Dude, I want to do this. What the hell is illegal about this? Right? In my opinion, I cannot see anything in the least illegal about it. What I see is, I can move the markets, so I'm going to move the markets. And if I can profit on the markets, I'm going to profit on the markets. I don't see how this is illegal. I don't see it at all. But it's pretty epic. It is really epic. How could you even regulate this, right? Purposeful manipulation like that, I don't know. Is it purposeful? Let's ask this, right? Let's ask this. If I go out and I can swing a big enough banana, or I can buy all those shares and I push up the price, right? Let's say that I'm a smart investor and I'm like, oh, because price has gone up so much, maybe I should be buying puts to protect myself. And then I decide, you know what? I don't want these shares anymore. And those puts explode in value. This is honestly, to me, this is epic. This is something where it's like, I would do this all day, every day if I could. But then again, maybe I'm a devious trader. I don't know. But to me, this is awesome. To me, this is something I wish I could do. And I would do it every chance that I got. Every chance that I got. So listen, if you are ready to save time, make money, and start winning with less risk, there's 2 videos popping up right now on the replay, not on the live stream, but on the replay. You should definitely click one of those. Have a fantastic day.